Depending on where you're located, good morning or good afternoon. Welcome to today's webinar, Recent Trends in Nonprofit Balance Sheets and Capital Investment. Before we get started on today's webinar, I would like to go over several items that will help you participate in today's webinar. So first, some housekeeping details. We've taken a screenshot of an example of the interface that you should see on your computer screen. You should see something that looks like this on your computer desktop in the upper right corner. You should be able to hear the presentation now if you listen to the webinar via a computer speaker or a headset. If you prefer to join over the telephone, just select telephone option in the audio pane and the dial-in information will be displayed. Please feel free to submit your questions at any time during the webinar through the questions pane. We will be monitoring your questions and will collect them and address them during the Q&A session following the presentation. The full PowerPoint for today's presentation will be made available immediately after the webinar. Now I'd like to turn to the introduction of the presenters and the partner organizations. First, I'd like to introduce myself. I am Una Osili, Director of Research at the Indiana University Lilly Family School of Philanthropy. The school is a leading academic institution dedicated to increasing the understanding of philanthropy and improving its practice worldwide. I will be serving as the moderator for today's webinar, and so now I'd like to turn to introducing our presenters for today. First, Tom Pollock. Tom Pollock is the Program Director of the National Center for Charitable Statistics at the Urban Institute. The National Center for Charitable Statistics is the national repository of data on the nonprofit sector in the United States. NCCS provides a lot of research materials for the sector, including the Nonprofit Almanac and the annually updated Nonprofit Sector in Brief. Our second presenter for today is Dennis Gephardt. Dennis is the Vice President on the Moody's Higher Education and Other Not-for-Profit Ratings team. Moody's is an essential component of the global capital markets, providing credit ratings, research, tools, and analysis that contribute to transparent and integrated financial systems. Today's webinar is actually the final webinar in a three-part series. Discussions today will focus on nonprofits' use of debt to meet capital needs. The discussion will include new research from NCCS and also how capital needs and debt structure affect Moody's ratings of nonprofit organizations. Both presenters will be available at the end of the webinar to answer all your questions. Contact information will also be provided to everyone. Please feel free to submit your questions anytime during the presentations. Now I'd like to turn the presentation over to Tom. But before we do, we have a very brief polling question for all of you in the audience to get a sense of the extent to which debt is being used in the nonprofit sector, at least judging by our participants today. So we have a very quick question, and the question states, does your organization use debt of any type as a means to become more financially stable? And we have three options. Select one of these. First option is yes, our organization does use debt. No, our organization does not use debt. And the third option is a don't know. We will be monitoring this poll. I will announce the results before we start the presentation. Okay, I think the results are starting to come in from our polling question. You can see the results are in already, and we find that actually this is very interesting. 27% of the organizations in our sample are currently using debt as a means of becoming more financially stable. About half of the sample are not using debt of any kind. About 23%, a little less than a quarter, don't know. So this is quite interesting, and it does mirror a lot of the results from the nonprofit sector as a whole. And as we reflect on these, I just want to mention that the next presenter will be presenting a lot of results that provide information about the sector as a whole. Tom, I'm going to turn it over to you to continue the presentation, and thank you very much for your participation today.
Thank you, Una. So let me first give you a brief overview. Over the past 10 years, we've seen total revenue of public charities increase after adjustment for inflation by nearly 24%, and total expenses increasing slightly slower at 21%. In contrast, we see the level of assets held by public charities increasing by 27%, and much more dramatically, assets held in land, buildings, and equipment increasing by 37%. In contrast, the level of debt has not increased nearly as quickly. It has increased, basically at the same level as expenses. So total debt increased around 20% over that 10-year period after adjusting for inflation. Thinking in terms of key financial ratios, what we see is that overall, the ratio of assets to expenses increased modestly by about 5%, but much more substantially, the capital intensity of the sector, at least in this somewhat rough measure of land, buildings, and equipment assets in relationship to expenses, increased by nearly 14%. In contrast, what we see is dependence on debt decreasing somewhat. So we see approximately 19%, a little less than 20% now, of total assets being offset by debt, and around 2/3 of land, buildings, and equipment are now offset by debt, which is down from around 3/4 back in 2003. This next slide begins to kind of tease out the sources of debt, and what we see is tax-exempt bonds, although they represent only a very, very tiny portion of the types of debt being used. Only 3% of organizations actually use tax-exempt bonds. Nonetheless, they represent more than 2/3 of the overall debt of the public charities. In contrast, loans from officers and other key stakeholders represents only 1% of total debt of public charities. Moving now to the more conventional types of debt, we see that approximately 22% of public charities had secured mortgages or notes payable, and these accounted for approximately 25% of overall debt. So secured mortgages, that would be your typical mortgage. Secured notes payable might be backed up by collateral and some other type, typically accounts receivable. And then we also see a relatively small percentage of organizations with unsecured notes and loans payable. Those represent around 6% of public charities and an equal percentage of the overall debt. Let me give you kind of a bird's eye view of what the characteristics of organizations are that are most likely to use debt. This is based on a logistic regression analysis that one of my colleagues did earlier. And what we see, not surprisingly, is that organization size is certainly correlated with the use of debt. Larger organizations are more likely to have debt than smaller ones. When we look at the different types of organizations, an interesting picture emerges. Not terribly surprisingly, colleges and universities are, setting aside size as a factor, are more likely to hold debt than other organizations of similar size or age or other characteristics. In contrast, arts organizations and environmental organizations and international organizations are not correlated with use of debt. In fact, environmental organizations are less likely to use debt, all other factors being held constant. Not terribly surprisingly, we also, moving down the list, see that age is positively correlated. So older organizations are more likely to hold debt. We also see that organizations that depend on program service revenue, here's a classic earned income from ticket sales in the arts, or patient revenues in healthcare, or whether from government or private sources, as well as some of the contracts that human service organizations receive from government. Organizations with those types of sources tend to be more likely to have debt as well. The final variable here is what we call the fixed asset ratio, which is simply the percentage of total assets that can be found in land, buildings, and equipment. And we see that that also is positively associated with holding debt, which is so consistent with the idea that we'll explore further that in all likelihood the dominant use of debt is for financing real estate. I'm now going to run through a series of slides that kind of make that earlier regression analysis a little more concrete for you. Looking at the public charities in 2012 by their level of total expenses, we see that only 16% of the smallest organizations, those reporting less than $250,000 on their Form 990s or 990 EZs, had any debt of any kind. In contrast, at the other end of the scale, we see that nearly 2/3 of the largest organizations had debt of some type. Next, we move on to the use of debt by different types of organizations. And at one extreme, we see higher education, with 70% of colleges and universities holding debt. At the other end of the scale, we see international organizations. Only 14% have debt of any kind. Hospitals are not terribly far behind higher ed at around 60%. And in this slide, we've also broken apart two different categories of human services, those that rely primarily on labor to provide their services, and then the more capital-intensive human services, which are primarily in the housing and community and economic development fields, where we see nearly 60% having debt. Moving on, we see that depending on the level of reliance on earned income, on program service revenue, the percentage of organizations holding debt does increase at a steady rate, not as dramatically as we saw in those earlier slides, but still certainly very substantial differences from those with no earned income to those with more than 2/3 earned income. Now we turn to debt in relationship to dependence on debt as a percentage of assets. So what we see is that fully 71% of organizations actually had no debt whatsoever. So all in all, the use of debt financing is limited to less than 1/3 of public charities. Of the remaining organizations, we see approximately half of them had less than 1/3 of their assets in associated debt. And then the remainder were roughly equally distributed between those with 1/3 to 2/3 of their assets probably being secured by comparable, or serving as security for comparable debt. And then we see another 7%, or 1/4 of that total, where the debt to asset ratio is greater than 2/3, which some might argue puts them in a relatively vulnerable position. The percentage of assets financed with debt by organization size, I'd say these results are certainly not surprising. What we see here is that at the lower end of the size scale for organizations with less than $250,000 in total expenses, overall debt represented approximately 10% of assets. And we're showing that debt to assets ratio in two different ways. The first way is simply totaling up all the debt for all the organizations with less than $250,000 in assets, and then dividing that by the sum of the assets for all those organizations. The second way, which yields similar but not exactly the same results, is simply taking the average debt to asset ratio for each organization and averaging that. So at any rate, what you see here is a range on the first column, the overall debt to assets ratio, between 12% and 20%. So certainly large organizations are much more likely, again, to use debt. Now we turn again to percentage of assets financed with debt by type of organization. Here we see environmental organizations and international organizations at the very low end of the scale, with debt representing only around 6% of total assets. In contrast, we see the capital-intensive human services, where debt represents nearly 50% of total assets. So that would be consistent with the idea that if you're a community development corporation or doing other kinds of housing work, you're very dependent on that, securing loans or tax-exempt bonds to cover your construction costs. Hospitals and higher ed, the percentages here are not nearly as dramatic as we saw in the earlier slide. Here what we see is that in higher education, for example, debt represents about around 17% of total assets, and that's the hospital arena. Debt represents nearly a quarter of total assets. Next, we look at the percentage of assets financed with debt by organizations, so dependence on earned income or that program service revenue from the IRS Form 990s. And here there's certainly a dramatic story that we see. Organizations that have no program service revenue, only around 5% of their total assets appear to be in equivalent debt. That percentage jumps to more than 2/3 when we move into organizations that have at least 2/3 of their total revenue from program service revenue. Next, we turn to a stacked bar chart that looks at growth in revenue in relationship to levels of debt. And I'd say this is probably one of the more surprising slides. What we see is that for organizations with no debt whatsoever, they were both more likely to show major gains in revenue over the 2003 to 2012 period. So 42% showed major gains, but they were also more likely to show major losses, with 26% showing losses of 25% or more over that 10-year period. At the other end of the scale, we see that those organizations with the highest level of debt, 31% of them showed major increases over that 10-year period, while only 18% showed substantial losses. Then we cut to the sort of bottom line here, is to try to answer the question, if an organization had more than 2/3 of its assets potentially tied up in debt, were they more likely to close? And the short answer is yes. Organizations that held no debt in 2003, approximately 1 in 5 of them closed during that 10-year span. When organizations did hold some debt, but it was at a fairly low level, representing less than 1/3 of their debt of their assets, we saw around 14% closed during that 10-year period. That jumps by 10 percentage points to nearly 1 in 4 organizations in that highest category. Those with more than 2/3 of their assets probably tied up in linked to debt. So there certainly are more questions we could begin to answer looking at the IRS Form 990 data, but that will have to wait for a future webinar. We did, however, want to try to get a better handle on the extent to which debt was being used for short-term versus long-term purposes. And to do that, we turned to audited financial statements of a very small sample of organizations, approximately 100 public charities that were registered with the state charity office in Massachusetts, and that were required to file their audited financial statements. And Massachusetts kindly makes them available on their public website. What we found is that more than half were using debt to meet their short-term capital needs, and 55% of those organizations also stated that they used or at least had access to a line of credit. And then more than 3/4 of these charities use debt to finance real estate, or either real estate purchases or renovations. To try to get a little better handle on the use of debt for real estate, we did this little kind of crosstab that seeks to kind of break apart that kind of general category of land, buildings, and equipment. Equipment could include things like your computers, cars, lots of other things outside of real estate. So we unfortunately have no simple way of distinguishing these different types of holdings on the 990, at least given the data that we have available for research purposes. So what we often do is look at some organizations that have over a certain level of investments in land, building, and equipment, and can, I think, reasonably make some assumptions that if you have more than $100,000 or certainly more than $500,000 in land, buildings, and equipment, then it's very likely that you do have some real estate investments, or do have some assets tied up in real estate. So what we see here is at one extreme, we see that for those organizations that almost certainly do not have real estate and that are small, we see only around 2% of those have any debt at all. This circle in the upper left corner. Even among the largest organizations, but those with very little in land, buildings, and equipment, we see only 9 or 10% of those organizations using debt, which leads us to conclude that clearly debt is very, very likely to be used for real estate purposes. As we move to the right here, somewhere between this $100,000 mark and the $50,000 mark, we see that if you have substantial assets tied up in real estate, the odds of you having some sort of debt increase quite substantially. So looking at the greater than $10 million category, we see that 2/3 of organizations in that category with at least $100,000 in land, building had debt, and then that increases ever so slightly as we move all the way to the right to around 73% of organizations, nearly 3 in 4 that had at least $1 million in land, building, equipment. So you could kind of roughly speculate that probably around 3/4 perhaps of organizations that have land, buildings, and equipment do rely on debt financing for their land and buildings. So in conclusion, as we saw in an earlier slide, only around 29% of public charities use debt at all. Of those that do, the larger or well-established organizations, the older ones, and especially those that have good steady sources of program service revenue or earned income, are more likely to use debt, not terribly surprisingly. And we also see that in our small analysis of audited financial statements, we do see substantial use of debt for both short-term capital needs as well as long-term real estate purchases. But the use of debt for real estate purchases certainly is well above its use for short-term needs. And then I think it's fair to say that the study really represents just the tip of the iceberg of what we would like to know about these issues, and much remains to be learned about the use of debt for financing program expansion. I think certainly an area of great interest to philanthropy these days. And we look forward to reporting on further research over the next year. Let me now turn the mic over to Dennis, and he will talk more about his perspective from Moody's.
Very good, and thank you, Tom, for sharing the results of those studies, and we look forward to furthering this conversation through the next slides, as well as our question and answer time at the end of the hour. And this is an especially appropriate time to be discussing nonprofit capital needs, nonprofit balance sheets, and use of debt. Like the rest of the country after the recession, many not-for-profits have been in a mode of deleveraging, asking questions about funding their capital needs, about potentially taking on debt and finding an appropriate balance is always foremost on their minds. As we move through the next two slides, I'm going to try to explain how Moody's approaches the ratings of the credit quality of not-for-profits and how balance sheet and capital investment and debt considerations play into that. And then some recent trends of debt and capital investment in the sector. And we'll see that in the post-recession climate, many have been holding off on capital needs. And also how the management of debt and debt policies can play into our credit opinion. Now, if one word on the size of organization, and Tom's data showed organizations with more than $10 million in revenues or expenses tend to be more likely to have debt. Most of the organizations we rate are larger than 10 million, many much larger than that. They tend to be established in terms of their timeline history, but much of what we're relaying today would apply to smaller organizations as well. So Moody's has 4 primary methodologies that help us assigning ratings for this large nonprofit sector. Overall industry revenue mix of $1.5 trillion. It's interesting that healthcare and education did see some revenue and employment growth over the last decade and correspond with a good deal of growth in the sector. But those each have unique methodologies, so not-for-profit hospitals and health systems are the governing methodology for that sector, as well as the human service providers in the health area. Then in the education field, an important part of this sector by revenue and assets, we have a methodology for higher education as well as K-12 private independent schools. And then in a methodology published earlier this year in March, not-for-profit organizations, you'll see that we group into 4 different sectors, and some of the slides will deal in that subsector in particular. So stepping back and just thinking about the capital intensity of these subsectors, they do vary quite markedly how their capital needs and the amount of leverage that they might have on the median relative to those needs. And you'll see that cultural organizations, and here we rate a number of endowed museums and performing arts organizations that tend to be larger and tend to have capital intense campuses. And we're defining capital intensity here as the amount of property, plant, and equipment net of depreciation relative to operating revenue. So how much plant is needed to generate $1 of operating revenue. And so that spans from the top of the museums and performing arts organizations down to the bottom of the philanthropic group that are mostly large grant-making foundations with minimal capital needs beyond perhaps office space. The K-12 private schools below that are more capital intensive than most others, and the independent schools that we rate tend to be the wealthiest with the strongest market positions with deep philanthropic support that tend also to have very nice facilities, the classroom, athletic, and in some cases these are boarding schools, so there's residential facilities in the mix as well. So thinking about those other not-for-profits, and as we are assigning ratings to debt, we create a number of median measures, and the medians are available on the webinar homepage. But you'll see 2 measures that are related to capital and balance sheet: median cash to expenses in the green bar and median cash to debt by broad rating category. And you'll see that the AAA or the highest rated organizations tend to be the strongest in terms of the coverage, so cash and investments to their operating expenses and debt in the 10 times range, falling for the AA's, and then for the A-rated category around 1 to 2 times. So as Tom's data suggested, our median analysis also reveals that most of these not-for-profits have manageable debt burdens. So their managers and boards have found a way to meet their capital needs in a way that doesn't either underinvest in capital or overly tie future managers' hands in terms of having a high debt burden. And in fact, you'll see in the second bullet there, the median amount of the budget devoted to debt service is under 4%. So the debt, by that measure, appears relatively affordable. And then the median amount of debt for these organizations, again, tend to be larger, is around $70 million or just over $70 million. And on a debt-to-revenue basis, that's about 60%, as you'll see here in the red line, a line that's been relatively stable but edging downward. The methodology for not-for-profit organizations is also available on the webinar page, but it includes 3 quantitative and 3 qualitative factors that are used to assign ratings through our process. And over on the left side here, I have the standard weighting for those 3 quantitative factors. Their market position, operating performance, and balance sheet and capital investment. So you'll see of these 3, balance sheet and capital investment is the highest in terms of weighting and very important, we believe, to forming an objective opinion about the future credit quality of the organization. And that 45% weight on balance sheet, you'll see is further divided 3 sub-factors, each with 10% of total cash and investments, so just a raw measure of the scope of the financial resources of the organization, and 1 capital ratio of flexible reserves relative to direct debt, flexible reserves relative to operations, and then 3 measures, each with 5% debt to operating revenue, so that measure of operating leverage, monthly days cash, and monthly liquidity to demand debt. So when understanding the broader capital program of a not-for-profit, it's important, I think, to not just understand the role that debt plays, but how the entire program is funded. And the financially strongest not-for-profits exhibit a consistent ability to fund their capital needs from a variety of sources. And debt is really just one of the 5 components that we've listed here. For others, it may be government funding through grants. It could be local, state, or federal, other government sources. Gifts are an important part of funding the capital program for many not-for-profits. And then the other 2 are really kind of self-generated in many cases, either operating cash flow or the net equity of the organization can also be an important source of the capital needs. And often the choice of the funding instrument may vary by the project purpose. There are many capital needs that, for example, may not have a clear revenue component or engine of repayment, but are nevertheless needed for the organization's mission that might be more appropriate for gift financing. And also the funding can vary by the useful life of the asset. And the debt, as we'll get into more, can be through a variety of instruments, either publicly traded debt, bank loans, or private placements with a number of investors. So the deleveraging that I mentioned in the sector can be seen here in the pace of capital investment. So over this multi-year span, we'll see that the pace of capital spending has really slowed. The black line on this chart is the median age of plant that compares accumulated depreciation to the depreciation expense for any given year. And you'll see across this era at 2009, that was around 9 years and has grown to 1.5 years to almost 10.5 years across this era. And then the orange, the stacked bars show the various rates of capital spending. So those in the orange-red would be that share of rated not-for-profit spending less than their depreciation expense each year. And if you think of that as a proxy for stability and ongoing and regular reinvestment in plants, or more organizations not meeting that threshold of equilibrium in terms of capital renewal. And so a potential area for increased needs in the future as some needs may be deferred. Next two slides bridge the topic that we had in webinar 2 in terms of the role of governance and management in not-for-profit credit quality, with a particular focus on debt, understanding debt, and debt policies. So the debt policies are, in many cases, an important tool and process, really, that establish how debt will be used by the nonprofit. Often it will establish what the organization's tolerance for risk is. And as Tom's data showed, there's a case to be made that the prudent use of debt can foster growth, but there's danger both in having too much and in some cases in underinvesting in debt finance capital or having too little. And finding the right balance through a policy such as a debt policy can be a credit positive exercise. So these policies might lay out the range of purposes that debt may be used for. So that could be just capital needs, it could be capital or operating needs, and some of these organizations do have operating lines of credit that they draw on occasionally. The policy might also approach debt structure, and we'll talk more about that on the next slide, including the use of variable rate debt and derivative instruments. And in terms of the tolerance for risk, the policy might also establish guardrails on the amount of leverage through various means, may assign a numeric or other measure where this amount of debt is acceptable, but more than that would be greater than the leadership is comfortable with or they deem appropriate for the organization. The debt policies also typically incorporate the plan for repayment. So with each major borrowing, the board may vet the cash flow plan so that as the debt is repaid, for establishing a business plan or some kind of net revenue plan for how the debt will be repaid, and thinking about the impact on the organization's operations in the future. And they may also approach the issue of bridge financing of gift expectancies. So that might include a threshold of fundraising achievement before borrowing or before embarking on a capital project. And the stronger debt policies are not static, but are subject to monitoring, reporting, and also periodic review. And if you think about many of these debt instruments might be very long-lived, so 30-year agreements, so would last longer than any individual staff member typically, also longer than some of the board members or other key parties. And so establishing that commitment and understanding the ongoing demands from external reporting or creditor relationship is important. And then finally, on the line chart on the bottom of the slide, you'll see that after the liquidity crisis of 2008, that many not-for-profits have steadily reduced their variable rate exposure. So the portion of their debt that's variable rate was approaching 80% in 2008 and is now down below 40% through active de-risking of the portfolios across that era, partly in response to the risk that had emerged. I want to spend a few minutes on the particular debt structure risk, and it was interesting, but the Lilly Family School Survey that was reported in webinar 1 mentioned that many nonprofit managers had little experience in debt structure issues, and I think it's an important point that all of these are learned things, and for smaller not-for-profit organizations well outside their primary wheelhouse. And while at work, most of the organizations I work with are large and well above 10 million in revenue and size, as a private citizen, I'm on the board of a nonprofit that's much smaller, so below $2 million in revenue, and has a small amount of debt, and so in that role often are wrestling with these issues that smaller organizations face. So one of the distinguishing features that we find of credit quality is the level of management awareness and understanding of the risk involved in debt structure, and it varies widely. On the credit positive end, there are teams that are keenly aware of the risk, have mitigation plans for those risks in place, actively manage their counterparty relationships, and are entering into agreements very much with their eyes wide open. And then on the other end of the spectrum, there are those teams that are less aware, that may be less experienced, and are relying a good deal on intermediaries or others, which is fine for advice, but at the end of the day, the expectation would be of an understanding of the risk that variable rate debt brings in. And here on this slide, we've compared the related risk for both bank debt and variable rate demand bonds. And you'll see 3 of them are shared and 2 are unique to variable rate demand bonds. So the interest rate risk is one that's easy to understand. So this is the risk of unexpected and or protracted rise in interest expense. Renewal risk speaks to the risk of a bank agreement, whether for bank debt or publicly traded bonds, expiring before either it was extended or the organization found another liquidity provider. And then you'll see 2 of the risks, remarketing risk and counterparty risk, have to do with the publicly traded bonds that in some cases the nonprofit organization may be functioning fine, but because of market changes or market perceptions of the counterparty may experience disruption in their debt structure. And with that, I'll turn the microphone back over to Una and look forward to the question and discussion period.
Well, thank you, Dennis, and thank you to both of our presenters. We've had a number of questions that have come in during the webinar, and so let me just take a moment to direct a couple of those questions over to Tom, first of all. So Tom, in the study, one participant wanted to know how the closure rate was measured for nonprofit organizations, and also another data question looking at how affiliate networks are measured in the sample. So a lot of nonprofits have umbrella structures. How are debt measures taken for those within those networks?
Okay. Closure rates were measured by whether or not the organization was still considered registered with the IRS. It's not a perfect measure, but we think it's our best proxy measure for an organization totally shutting its doors. The alternative to that is to look only at whether or not the organization still filed a Form 990 or 990 EZ, and a case can be made that that's a better measure in some instances. But there's no perfect measure. In terms of the umbrella organization question, for purposes of this look, we only focused on looking at the entity as it is registered with the IRS, so the single legal entity. We were not able to link the entities together if they were related to each other.
Wonderful. Thank you, Tom. And I'm just going to take the moderator's privilege here and pose a question to Dennis. Dennis, one of your slides showed sort of an interaction between debt and other forms of funding available to nonprofits. And I just wanted to ask what you think. I mean, this is could be an area for further research, but perhaps speak to the relationship between debt and other sources of funding. How do private donations respond to debt? In other words, are donors less likely to provide philanthropic support when there are high levels of debt? How does that affect ability to secure grants from government? So I'll ask Dennis just to touch on that briefly, and perhaps Tom can talk about that also from the point of the larger database, if we have any indicators of the interactions with the different sources of funding available to nonprofits.
Great. Thank you for that, Una. So most of our rated organizations tend to be large and tend to, of course, have debt as part of their program, as a lasting part of their balance sheet. And I think that if they have made responsible use of debt, that their donors and potential donors, their grantors and potential grantors, are sophisticated enough to understand and comprehend their responsible use of debt. From time to time we hear that donors are interested in kind of the broader credit quality, the broader strategic direction of the organization, and that certainly plays a role in the credit analysis. And so you are right to suggest some important ties between credit quality and support from donors and grantors.
All right, we have a number of questions that just came in, and I'm going to try, I'll just sort of summarize them very quickly, and we'll have Dennis respond, and then Tom can respond as well. The first question is regarding healthcare. Why is healthcare shown as having low capital intensity in the data? The second question asks if there can be a definition of operating revenues as well as debt service provided, just so that participants can better understand those terms. And then finally, whether we have any information about the terms of borrowing. Are nonprofits receiving adequate information around the question of terms of financing, and also for nonprofits that would like to use debt but currently lack assets, that could collateralizable assets, what are some options that can be used as collateral? In other words, can reliable revenue streams serve as collateral? So that's a multifaceted question, so I'll let Dennis jump in, and then perhaps Tom can speak to that as well.
Very good, thank you. And first, on the topic of the capital intensity by subsector, I shared your initial reaction, the questioner's initial reaction. Why is healthcare that scoring lower on this? And hospital rooms, hospital bed towers are incredibly capital intensive. But if you think about it in this light versus, say, the art museum or the cultural organization that's got 4 times, that the healthcare resource is used much more intensely. It's used in many cases 24 hours a day. And so while it's a very expensive facility, it also is used, and these credit-worthy not-for-profit hospitals manage closely and try to keep their occupancy very high and use those resources in a very efficient manner. And so the assets are more expensive on a per square foot basis, but used much more intensely. If you compare that to the museum that might be open, 60 hours a week, on some of those days of the week, be generating very low visitation, very low earned revenue, that it makes more sense in that light. And then in terms of the definition of our ratios, both the medians and the methodology report do have sections in the back explaining the definitions, but operating revenues are, in short, based on unrestricted revenues. We do make some adjustments for net assets released and endowment spending that the report can provide more detail on. And debt service is annual interest expense and principal expense when appropriate, and the principal expense is occasionally smooth if there are irregularities in any given year.
Okay, well, it looks like we are right at the end of the presentation. I do want to thank our presenters, but also thank all the participants for attending today's webinar. If you have any other questions, please feel free to contact any of the presenters. You have the contact information here. After today's webinar, you will receive a follow-up email with a link to view a recording of today's webinar, as well as the PowerPoint, along with a short survey on the presentation. We would greatly appreciate it if you would complete that survey and provide your feedback. Your evaluation will be very beneficial to our work, and so on behalf of the Moody's Foundation, the Urban Institute's National Center for Charitable Statistics, and the Indiana University's Lilly Family School of Philanthropy, and all our presenters today, thank you for joining us, and enjoy the rest of your day.